We need to wait until the stock market goes way down in value, because then when we buy in, it'll go back up and we will make a ton of money. But the way that we figure that out is to work with some professional investor, like a manager or somebody who's done this for a really long time. They know what they're doing and they can manage our money for us. But before we ever get started, we've got to save up a ton of money, like 10 grand, 20 grand, even $100,000 before we get started, so that we have a big nest egg and a big snowball to get going and get us building as much wealth as possible. Except that everything I just said is a lie. And here's why. The real way that we should be investing is a 3-part matrix. Number 1, alone. Number 2, with very little money. And number 3, over a long period of time. But why? Well, what most people envision when they think about stock market investing is the opposite of what we should all really be doing. Most people picture this, that the stock market goes up and down like an EKG machine in a hospital. And because it's always going up and down, the real way that we can target it and make as much money as possible is to have a bunch of cash saved up, watch that little chart go up and down, bobbing up and down at random, and then figure out what stock is on its way up. The way we do that is through magically interpolating some charts or getting a tip-off from somebody who knows something that you don't, and then quickly invest all your money in that thing and make tons and tons of profit in a relatively short amount of time. So if we have that information, if we have the cash, if we have the tip-off or the manager or whoever, then we'll win with money. This philosophy is just wrought with errors. Because number 1, no one has all that information. If anyone claims they do, they're lying to you, it's a scam, or they're lying to you and they're just trying to get your money so they can manage it for you and make as much money as possible themselves. And number 2, the odds are that the average person doesn't have a large sum of cash just sitting there with no purpose other than waiting to be invested. That's not the world we live in nowadays for the vast majority of us. And number 3, that's not how the stock market moves. That chart is not an EKG machine. It works totally differently. So what do we do then? And how do we make as much money as possible as regular people without some kind of special insider trading information, which is illegal anyway, by the way? And how do we do this on a budget? This is where things get counterintuitive, because the first principle of this matrix is that we have to invest alone. This is different than most areas of life where you want to get professional help. If you need medical help or if you want to learn something new, you typically hire someone who's a professional in that specialty, and it gets you better results. You learn faster, or you do better, or the quality is higher. Everything improves. The opposite is true with investing. You should be investing alone. The truth about a professional investing manager is they almost never offer any insight or profit-adding strategies over and above what you could figure out by yourself. And in the process, they rob you of 27% of your overall profits from investing. Whenever you do the math and you figure out what something like a 1% asset under management fee really means, it's like 27% of your profits. They do not deserve 27% of all of your investing profits for your whole life, so don't give it to them. Part 2 of our investing matrix is that we need to just use a little bit of money when we invest, not a lot. Let's be honest, inflation has wrecked most of our budgets in the last couple of years, and everything has become way more expensive, and our pay hasn't risen proportionally with that. That means that we have less disposable cash than ever, yet we still need to be investing. So how do we do this? Well, the answer is to invest as much as you can, no matter how small that amount is, and go through your investing service to set that up to be automatic. The reason that we do this with a little bit of money and we do it automatically is that you're investing whether you feel like it or not, whether you remember to or not. And because of the power of fractional shares, you still get to invest in the biggest, most profitable, expensive, successful companies in the world, even if you're investing $10 a month or $20 a month. And something that I don't think everyone realizes is that over time, you acclimate to that money being gone. You're just used to not having that $20 or whatever it is, and your life adjusts. That means that initially you feel the sting of not having the money, but after a few months or 6 months, you don't feel that anymore. And so as time as income allows, you increase the amount that you're investing automatically as often and as much as you can, so that over time you're investing more and more and more while accumulating wealth faster and faster and faster. And the reason why this works is because of our third and final part of the matrix. That's investing for a long time. Despite stories in the news or rumors from your friends or your Uncle Steve, the stock market is not a place to get rich quick. Just like the lottery is not an investment strategy. Just like Subway sandwiches are hot trash and should be avoided at all times. These all are facts of life. The best way for us to invest and get the most money with the least amount of effort and risk is to invest over a long period of time. This means that you're realizing the benefit of the stock market when it's low, because you're buying new investments for a nice cheap price because it's all automated, right? And then you're benefiting from having all your money invested in the stock market when it is going up. And on top of that, it's paying you dividends. So if you look at the data from the stock market over any 10-year period, starting in the 70s and working up till now, even the worst 10-year period, no one is losing huge amounts of money if they stay invested and if they're well diversified. The worst 10-year period in that time frame only went down 3%. Losing 3% is a drop in the bucket over your lifetime. And over a 20-year time frame, if you're investing in the stock market, you're staying in it, you're not selling out, everyone is making money. Period. There's not a 20-year period where someone lost money in the stock market as long as they're well diversified in something like an S&P 500 index fund. The worst 20-year period in the stock market still went up 6.4%. It's crazy. So why don't people do this? Why don't they take advantage of this money-making opportunity? Well, the problem is that people create issues for themselves by getting in and out of their investments too frequently and at the wrong time. Here's a classic mistake that everyone makes, including myself. I've done this, and that's to watch the stock market and see that, oh my gosh, it's been going up and up and up. Well, I don't want to miss out on that opportunity. I don't want to miss out on that growth, so let's invest some money. Then months or weeks later, we see things start to level off and drop. And at first, we're not that concerned because we understand this is going to happen. But then the unthinkable thing strikes and our investments go down significantly more than we expected them to. And so we sell, we get out. This is a sinking ship. We got to get our money out of there because we're not going down with that ship. We're not the captain. So give me my money back quick before I lose more. That is the exact perfectly wrong thing to do because you've ensured that you were invested at the perfectly wrong time frame. You exited the stock market before it could rebound while it was still down, before you could realize the benefits of having that money invested, and you've ensured that you have lost as much money as possible. But this strategy that I'm talking about of buying in over time with small amounts of money for a long period of time alone only works if you don't cherry pick stocks. If you don't pick some trending crypto coin like a numbskull does, you've got to be investing in something broad, diverse, like an index fund, like an ETF, like something that tracks a vast, vast number of companies so that you're not putting yourself at risk. But what the heck are those terms? What's an index fund? What's an ETF? What's the difference? Well, this video explains all the differences and everything you need to know so you can build your wealth and win with money. So watch this next and get on with it.